Welcome to the deep dive. I'm really glad you're with us today because we're about to unlock a part of the tax code that could genuinely, well, transform your tax bill. Seriously, imagine significantly cutting down your taxable income just by, getting a handle on a few key rules. Okay, let's unpack this. Today we're taking a deep dive into the qualified business income or QBI deduction. It's a real powerhouse for self-employed folks and small business owners, designed specifically to put more money back into your pocket.
Yeah, and what's fascinating here isn't just, the deduction exists, but how much strategic thinking really goes into maximizing it. So many individuals might be missing out on pretty substantial savings simply because the rules, well, at first glance, they seem incredibly dense.
Exactly. They can be intimidating. And the roadmap we're following for the 2024 tax year is Form 8995A, Deduction for Qualified Business Income. Look, this isn't just another form. Think of it as your direct pathway to understanding, calculating, and yeah, ultimately claiming this powerful deduction. So our mission today, break down Form 8995A into, let's say, digestible, actionable insights. We'll explore who's eligible, how the deduction is calculated, and crucially, the practical strategies you can use to make sure you claim every bit of QBI deduction you're entitled to. Think of this as your shortcut to becoming really well-informed in a vital area of tax planning, giving you the confidence to, optimize your tax position. So let's kick things off with the absolute core. What is the QBI deduction and who exactly gets to claim it? At its heart, the QBI deduction, it's found under Section 199A of the tax code, allows eligible self-employed individuals and small business owners to deduct up to 20% of their qualified business income. Now, this isn't some minor adjustment. We're talking about a potentially massive reduction in your taxable income. And that translates directly into, well, significant tax savings. It's a provision really designed to stimulate the economy by lightening the tax burden on those who, drive the freelancers, the small shop owners, the innovators.
That's absolutely right. And for you listening right now as an individual or maybe for eligible estates and trusts, Form 8995A is the precise tool you'll use to navigate this deduction. The fundamental condition, the starting point really, is having qualified business income, QBI, or maybe qualified real estate investment trust REIT dividends, or qualified publicly traded partnership PTP income or loss. Now here's a really crucial first decision point, one that immediately kind of streamlines your path through the tax landscape. There are specific taxable income thresholds for 2024 that dictate which form you actually need. So listen closely here. If your 2024 taxable income, and this is calculated before you even take the QBI deduction, is more than $383,900 if you're married filing jointly, or if it's more than $191,950 for all other filing statuses, single head of household, etc., then Form 8995A is your form. That's the one we're diving into today. This is the more detailed form. It's used when your income reaches levels where additional complexities and, frankly, limitations come into play.
However, and this is a critical distinction, it can save you a lot of headache if your income falls below these thresholds. Then you'll use the simpler form, 8995, which is actually named Qualified Business Income Deduction Simplified Computation. It does what it says on the tin. This immediately directs you to the correct and often much, much less complicated path. Understanding this initial threshold, that's your first strategic step to efficient tax prep. Ensures you don't overcomplicate things unnecessarily.
That's a perfect way to start. Just knowing which form to grab right off the bat must save so much time and, yeah, potential frustration. Now, let's talk for a sec about who doesn't directly file Form 8995A, because the QBI deduction still impacts them, just through a different mechanism. If you're involved with S corporations or partnerships, for example, these entities themselves, they don't file Form 8995A.
Right, they act more like conduits.
Exactly. They pass through all the necessary info about your share of the QBI, the W-2 wages, the qualified property. All that stuff comes to you as a shareholder or partner. This information will usually arrive on an attachment to your Schedule K-1. So you will then use that info to figure out your own QBI deduction on your individual return using Form 8995 or 8995A. Similarly, cooperatives provide their patrons with the necessary details, usually on Form 1099 Test PATR or an attachment. And there's also a special deduction for certain agricultural or horticultural cooperatives under Section 199AG, but that's handled at the co-op level, not by the individual patron using this form.
Okay, what about estates and trusts? That sounds like it could get a bit more complex. It could be, a little more nuanced. If a grantor or another person is treated as owning all or part of a trust, like in a grantor-trust situation, then that owner computes their own QBI deduction as if they received the income directly. Pretty straightforward there. But for non-grantor trusts or estates, they have an important choice. They can either claim the QBI deduction themselves, on the trust or estate return, or they can pass through the necessary QBI information to their beneficiaries. The allocation of these QBI items, income, wages, UBIA, it's based on the proportion of distributable net income, or DNI, that's either distributed or retained by the trust or estate.
Okay, so it follows the income flow.
Exactly. If there happens to be no DNI, then all the QBI items are allocated to the estate or trust itself. A key point to remember here is that any QBI items allocated out to beneficiaries are not included in the estate's or trust's own QBI deduction calculation. Prevents double dipping, you see.
Makes sense.
And one more specific case, electing small business trusts, or ESPTs. They have a special rule. They have to compute the QBI deduction separately for their S corporation portion and their non-S corporate portion. They actually attach their Form 8995A computations for the S portion as a PDS to their ESPT tax worksheet, so it ensures very distinct tracking.
Got it. So a lot of flow-through situations.
Absolutely. So if we kind of bring all these pieces together, for any individual, estate, or trust actually claiming the deduction on Form 8995A, your QBI deduction fundamentally equals your QBI component, which is typically that 20% of your qualified business income plus your qualified REIT and PTP component. However, and this is where the strategic challenge really begins, the entire deduction is then subject to an overall limitation. It cannot exceed the lesser of 1, that calculated amount we just mentioned, or 2, 20% of your taxable income. And that taxable income for this specific purpose is calculated before taking the QBI deduction itself, minus any net capital gain, plus any qualified dividends. This overall limitation, it's absolutely pivotal. It often acts as the ultimate cap on your deduction, especially, like you said, for higher income folks. Navigating this properly is the core of maximizing your savings, and it's precisely why Form 8995A is structured the way it is, guiding you through these complex calculations step by step.
Okay, with that foundational understanding firmly in place, let's really dive into the QBI component itself. Because this is where I think the deeper complexities lie, and therefore also the greatest opportunities for truly maximizing those tax savings. As we mentioned, it's generally 20% of your qualified business income from domestic trades or businesses. It sounds wonderfully straightforward, doesn't it?
It does initially, but that's until we start factoring in the critical limitations that kick in as your income rises.
Right, the plot thickens.
Exactly. For those with higher incomes, understanding these limitations isn't just about, checking boxes for compliance. It's about shrewd tax planning. These rules can significantly reduce that initial 20% QBI component, meaning you need to understand precisely how they apply to your specific situation to avoid, leaving money on the table. The IRS uses a pretty clear tiered system based on your taxable income, measured again before the QBI deduction. Let's break down these tiers because each one has a different impact on your potential deduction. It's really key to know which bucket you fall into. First up, if your taxable income is at or below the threshold, remember that's $191,950 for most single filers and $383,900 if you're married filing jointly for 2024, then you're in the clearest, most straightforward scenario. You generally don't need to worry too much about the W-2 wage or UBIA limitations that we'll dig into in just a moment. In this fortunate position, you typically get the full 20% of your QBI. That's the simplest and, frankly, most advantageous outcome for maximizing the deduction.
Okay, that's the ideal scenario. What happens if your income is higher?
Right, scenario 2. If your taxable income is above that threshold, but still within a specific phase-in range, this range goes from $191,950 up to $283,900 for most, and from $383,900 up to $483,900 for married filing jointly. This is where the deduction starts to get, let's say, squeezed. For individuals in this income bracket, the W-2 wage and UBIA limitations begin to apply, but they're not fully effective yet. The reduction is phased in. That means your deduction potential is gradually diminished as your income climbs toward the upper end of this range. This scenario requires careful calculations. You'll often need Schedule A of Form 8995A to figure out the precise amount of deduction you're allowed. It's definitely a zone where strategic planning around income can really make a difference.
It's a gradual reduction in that middle zone.
Exactly. And then the third tier. For those whose taxable income is above both the initial threshold and the phase-in range, so above $241,950 for most, or $483,900 for married filing jointly, then the full weight of the reduction applies. This means your QBI deduction becomes fully subject to what are known as the W-2 wage and UBIA, that's unadjusted basis, immediately after acquisition limitations. Now, why do these limitations even exist? Well, they're designed to kind of direct the deduction towards businesses that have a substantial economic presence.
Meaning they employ people or own significant assets.
Precisely. either by paying significant W-2 wages to employees or by investing heavily in qualified tangible property, the UBIA part. In this higher income bracket, your QBI deduction for a particular business or aggregated group is limited to the greater of two amounts, either 50% of the W-2 wages paid by that business or 25% of those W-2 wages plus 2.5% of the UBIA of your qualified property. This distinction is vital because it impacts, say, capital-intensive businesses differently from labor-intensive businesses. Understanding which limitation applies or, which one you might be able to strategically bolster is a key element of optimizing your deduction if you're in this higher income tier.
Okay, that 50% of wages or 25% of wages plus 2.5% of assets calculation sounds really important for planning.
It absolutely is. And just a quick specific note for patrons of agricultural or horticultural cooperatives, you have a slightly different reduction rule. Your cooperative QBI must be reduced by the lesser of 9% of the QBI allocable to qualified payments, or 50% of the W-2 wages from the trade or business allocable to those payments. Just shows how tailored some of these rules can be.
Right, specific rules for specific situations. That's a lot to consider, especially for those navigating the higher income brackets. Every calculation really counts there. Now, let's shift gears just a bit and talk about what actually qualifies as a business for this deduction, and just as importantly, what absolutely doesn't. Generally speaking, a qualified trade or business is one for which you can deduct ordinary and necessary business expenses under Section 162 of the Internal Revenue Code. This basically means your activity must have a primary purpose for income or profit, and you've got to be involved with continuity and regularity, acting like a legitimate business.
That's the baseline. But the exclusions are really key here.
Oh, yeah. There are crucial exclusions right off the bat. Businesses structured as regular C corporations, they're out. And so is the performance of services as an employee. That's a huge one for many people. Any amounts reported on your Form W-2 and Box 1, your typical wage income, that's never QBI because you're an employee not running your own business for that specific income.
But there's that little exception.
Right. The important nuance, a lifeline for some. If the statutory employee box, that's Box 13, is checked on your Form W-2, then those amounts can be considered QBI. This is a special exception usually for certain independent contractors like, say, commission-based salespeople or some truck drivers who are treated as employees for some tax purposes but still retain that independent business character for QBI.
Important distinction.
Definitely. Another critical point, especially for anyone transitioning from, say, traditional employment to self-employment. If you were previously an employee of a business and you continue to provide substantially the same services to that very same business after you're no longer technically treated as an employee, there's a 3-year presumption that you're still providing services as an employee for QBI purposes, which means that income might not qualify.
Ouch. That could catch people out.
It could, but don't despair. This presumption isn't absolute. You can potentially rebut it if the IRS raises the question. You'd need to provide clear documentation, things like contracts, partnership agreements, that really demonstrate your new, genuine, non-employee status. Just highlights the indispensable role of meticulous records and clear agreements.
Good record-keeping strikes again.
Always. Now, what about rental real estate? This is often a source of confusion, but it's also a significant opportunity. The ownership and rental of real property can qualify as a trade or business if it meets that continuity and regularity standard we mentioned earlier. It has to be run like a business. The IRS even provides a specific safe harbor. It's Revenue Procedure 2019-38, under which a rental real estate enterprise will be automatically treated as a trade or business for QBI purposes if certain conditions are met. These conditions mostly relate to the number of hours spent on rental activities and maintaining separate books and records.
So that safe harbor provides certainty if you meet it.
Exactly. But even if you don't meet the safe harbor, your rental activity might still qualify if it meets the general Section 162 definition of a trade or business based on all the facts and circumstances. Furthermore, and this is a very important point, often overlooked for tax optimization, if you're renting or licensing property to a commonly controlled trade or business, meaning a business operated by you or a related party or a pass-through entity you own, that rental activity is automatically considered a trade or business under Section 199A.
So renting to your own operating company qualifies the rental activity.
Precisely. It's a powerful aggregation type rule that prevents that income from being carved out just because it's rental. It's also important to remember that for pass-through entities like partnerships or S-Corp, the determination of whether an activity is a trade or business, that's made at the entity level. And here's another key insight that simplifies things for many. The material participation rules under Section 469, the ones for passive activities, they are not required to qualify for the QBI deduction.
Oh, that's interesting. So you don't have to be actively managing it day to day necessarily.
Right. As long as it qualifies as a Section 162 trade or business, even if you're not materially participating, the income could still be QBI. This broadens the applicability for a lot of people who might have more passive business interests.
Okay, this next section is absolutely pivotal for many listeners, especially those in service-based professions. We need to talk about specified service trades or businesses or SSTBs. Here's the big, bold takeaway. SSTBs are generally excluded from the definition of a qualified trade or business if your taxable income exceeds that phase-in range we discussed earlier. What this means in plain English is, if your income is too high and your business falls into one of these specific SSTB categories, then none of your QBI, none of your W-2 wages, and none of the UBIA of qualified property from that business will be considered when figuring your QBI deduction. This can significantly reduce or even completely wipe out your QBI deduction from that particular income stream. So understanding if your business is classified as an SSTB is absolutely paramount for smart tax planning.
Okay, so defining these SSTBs is critical. Let's get into the list.
Let's do it. We'll walk through the list of what the IRS considers an SSTB with specific examples, because the definitions can be quite detailed and, honestly, sometimes surprisingly broad. First, there's health. This includes highly skilled medical professionals, physicians, nurses, dentists, vets, physical therapists, psychologists, and the like. But, crucially, it excludes services not directly related to patient care, things like operating health clubs or spas, payment processing for health services, or manufacturing pharmaceuticals. It's about the direct service performed.
So the gym owner is probably okay, but the doctor running the clinic is likely an SSTB.
Generally, yes. Next is law. This covers lawyers, paralegals, legal arbitrators, mediators, anyone providing those core legal services. Again, it excludes services that don't require unique legal skills, like court reporters or stenographers. Then we have accounting, covering accountants, enrolled agents, tax preparers. Pretty straightforward. Performing arts includes the obvious roles: actors, singers, musicians, directors. But it excludes things like maintaining the equipment or broadcasting the performance, again, focusing on the direct performance itself. Consulting is broadly defined as providing professional advice and counsel to clients. Think management consultants, financial consultants, even lobbyists. But it thoughtfully excludes the performance of services other than advice like actually doing the implementation, direct sales, or providing training. And it also excludes consulting services that are so embedded in another non-SSTB activity that there's no separate payment specifically for the consulting aspect. That's a key area for potential strategic structuring.
Interesting. So if consulting is just part of a larger non-SSTV service package, it might escape.
It might, depending on the facts. Then there's athletics, professional athletes, coaches, team managers. But it excludes, say, maintaining the stadium or broadcasting the game. Financial services is a big one. It covers wealth management, financial advisors, investment bankers, anyone advising on valuations, mergers, capital raising. It specifically excludes traditional banking functions like taking deposits or making loans. But, and this is a subtle but important distinction, it does include arranging lending transactions between parties.
So the bank making the loan is okay, but the broker arranging it might be an SSTB.
That's generally the idea, yes. Brokerage services include stockbrokers arranging security transactions for a fee. But it explicitly excludes real estate agents and brokers and insurance agents and brokers. This is a common misconception. Real estate and insurance agents generally avoid this specific SSTB classification, which is good news for them. Investing and investment management covers those providing investing, asset management, or investment advice services for a fee. But it excludes directly managing real property. Finally, trading and dealing in securities, commodities, or partnership interests are also considered SSTBs, reflecting those highly specialized financial activities.
Okay, that's a comprehensive list. But you mentioned a catch-all category.
Yes, the potentially tricky one. Any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners. This can be demonstrated in a few ways: receiving fees or compensation for endorsing products or services, licensing an individual's image, likeness, name, signature, voice, trademark, or any other symbol associated with their identity, or receiving fees for appearing at events or on radio, TV, or other media formats. Think of a famous artist licensing their work, a celebrity athlete doing endorsements, or even a popular social media influencer leveraging their personal brand for income. This clause aims to capture those earnings as potentially SSTB income if that reputation is the principal asset.
Wow, that reputation or skill clause truly does cast a wide net. It could capture some surprising business models, but here's where we get to the, let's call them the aha moments, the crucial exceptions that can still allow an SSTB to qualify, offering vital tax-saving opportunities. It's not a complete door slam for everyone, right? There are pathways to benefit, even if your business technically falls into an SSTB category.
Absolutely. There are very important escape hatches, primarily based on your income level.
Okay, let's hear them. Exception number one, the income lifeline. If your 2024 taxable income before the QBI deduction is not more than $191,950 for most single filers, or $383,900 if married filing jointly, then your SSTB is treated as a qualified trade or business, period.
That's huge.
It is. Despite being an SSTB, you can still generate income eligible for the full 20% QBI deduction potential. This is often overlooked, but it's a powerful benefit for those with incomes below these thresholds. Exception number two, the phase-in opportunity. If your 2024 taxable income is more than that initial threshold, $190,950, $383,900, but not more than the upper end of the phase-in range, which is $241,950 for most, or $483,900 if married, filing jointly, then an applicable percentage of your SSTB is still treated as a qualified trade or business. This means a portion of your income from that SSTB can still qualify for the deduction. It gets more complex here, requiring you to complete Schedule A, Form 8995A, to figure out that exact applicable percentage. Now, if your income goes above the very top of that phase-in range, then unfortunately your SSTB generally doesn't qualify for the deduction at all. So understanding exactly where your income falls in these tiers is absolutely paramount.
So income is the key differentiator for SSTBs. Below the threshold, you're good. In the middle, you get a piece. Above the top, generally nothing from that SSTB qualifies.
Precisely. Now, let's talk about some absolutely critical de minimis rules that can help some businesses avoid SSTB classification entirely, regardless of their income level. These are genuine strategic lifelines for many. Rule number one. If your total gross receipts from a trade or business are $25 million or less, and less than 10% of those gross receipts come from performing services in a specified service field, meaning those SSTB type activities we listed, then your entire trade or business is not considered an SSTB. This is huge. It means your income from that business can be fully eligible for the QBI deduction, no matter your overall taxable income, as long as that SSTB component is relatively minor.
So a small percentage of SSTB activity doesn't taint the whole business if receipts are under $25 million.
Exactly. Rule number two, for larger businesses, if your gross receipts are more than $25 million and less than 5% of those gross receipts are from specified service field activities, then again, your trade or business is not considered an SSTB. So even substantial businesses can escape this classification if their SSTB-related activities are a really small sliver of their overall revenue. Another key planning opportunity, particularly for diversified businesses.
Lower threshold for bigger businesses makes sense.
Right. And finally, the minimis rule number three addresses a common scenario often seen in related party transactions. If your business provides services or property to an SSTB, and there's 50% or more common ownership between your business and the SSTB it serves, then that portion of your business that serves the SSTB is treated as a separate SSTB, but only with respect to the common owners. This is basically an anti-abuse rule. It prevents businesses from simply splitting off, say, their administrative functions that serve a related law firm to try and sidestep the SSTB classification for that income. Understanding these de minimis rules can be incredibly valuable for tax optimization and structuring your business activity strategically.
Definitely sounds like areas where careful structuring can pay off. Building on that idea of combining things, let's transition to another potentially powerful tax-saving strategy for those of you who operate multiple businesses: aggregation. See, while each trade or business is typically looked at separately when you apply those W-2 wage and UBIA limitations we discussed, you actually have the option, under specific conditions, to aggregate or, group multiple trades or businesses into a single one for QBI calculation purposes. This can be hugely beneficial. It allows you to combine the QBI, the W-2 wages, and the UBIA of qualified property for all the aggregated businesses together, which might help you meet those limitations more easily and, crucially, maximize your overall QBI deduction.
Okay, so grouping businesses together can help overcome the limits. What are the catches? What are the requirements?
Good question. There are strict requirements. First, you, or maybe a group of persons, must directly or indirectly own 50% or more of each trade or business you want to aggregate for a majority of the tax year. And all the businesses must use the same tax year end. This ensures genuine common control. Second, and this is a big one, a potential deal breaker. None of the trades or businesses you wish to aggregate can be an SSTB.
So SSTBs generally can't be part of an aggregation group.
Generally, no. If even one business in your desired group is an SSTB, you usually can't aggregate it with the others for this purpose. Though remember those SSTB income exceptions we just talked about. If your income is low enough, the SSTB is treated as qualified, so then it potentially could be aggregated if it meets the other tests. It gets layered. And third, the aggregated businesses must demonstrate they're actually integrated operationally. They have to meet at least two of the following three factors. A, they provide products, property, or services that are the same or are customarily offered together. Think of a bakery and a coffee shop next door, owned by the same person. B, they share facilities or share significant centralized business elements. This could be common personnel, shared accounting systems, IT infrastructure, HR departments, things like that. Or C, they're operated in coordination with or in reliance upon one or more of the other businesses in the aggregated group. Like imagine a clothing design studio, its dedicated manufacturing arm, and its own retail store, all under common ownership and working closely together.
So common ownership, no SSTBs, usually, and they have to be economically linked in some meaningful way.
Exactly. And it's important to emphasize consistency here. Once you choose to aggregate trades or businesses, you must report them that way consistently in all subsequent years. Unless, of course, there's a significant change in facts and circumstances that means they no longer meet the aggregation requirements. You'll need to complete Schedule B, Form 89995A, each year to show your aggregations, including any aggregations that were made by a pass-through entity in RPE that you have an interest in. You actually can't separate trades or businesses that an RPE has already aggregated on the K-1 they give you, but you can potentially add your own separate trades or businesses to their aggregation if they all meet the rules together.
So you can build on an RPE's aggregation, but not break it apart.
Correct. And the strategic benefit, as mentioned, is really about those limitations. By combining all the QBI, W-2 wages, and UBIA across related entities, you often create a stronger overall position to meet those W-2 wage and UBIA limitations. This can lead to a larger, more robust QBI deduction. It's especially helpful for businesses where maybe one has high UBIA but low wages, and another has high wages but low UBIA. They can complement each other within the aggregation.
That makes a lot of sense. Aggregation sounds like a really powerful tool for those with diverse but related business interests. Truly allows you to optimize the overall deduction. Now let's get into the real nitty-gritty. Let's define what constitutes QBI itself, what's in and what's out. This clarity is absolutely vital for accurate calculation, right? Making sure you're not missing out on eligible income or, maybe worse, incorrectly including non-qualified items.
Couldn't agree more. Precision here is key.
So what exactly is QBI? At its core, it includes qualified items of income, gain, deduction, and loss from your domestic trades or businesses. And these items have to be genuinely connected with conducting business within the United States. This casts a pretty wide net. It encompasses qualified items from various structures, partnerships, but not PTPs, remember, S corporations, sole proprietorships, and certain estates and trusts, provided these items are actually allowed in calculating your taxable income for the year. To figure your total QBI, you have to consider all the ordinary and necessary items attributable to the trade or business. This includes, but isn't limited to, things people might overlook. Unreimbursed partnership expenses, business interest expense, the deductible part of your self-employment tax, your self-employment health insurance deduction, and even contributions you make to qualified retirement plans like a SEP IRA or a solo 401k based on that business income. All of those reduce your QBI.
Wait, those are deductions from the business income, so they reduce the QBI number itself before you take the 20%.
Exactly. Now, equally important, perhaps even more so, is understanding what is not QBI. This list is crucial to avoid errors, maybe even audit issues down the line. First off, items that aren't properly includable in your income or income that isn't effectively connected with a U.S. trade or business, those are out. Your regular W-2 wages from an employer. Generally excluded unless, again, you're that statutory employee with Box 13 checked. We keep coming back to that one. Amounts received as reasonable compensation from an S corporation where you're an owner employee, not QBI. Guaranteed payments received from a partnership to a partner for services or for the use of capital, also not QBI. Payments by a partner for services performed when they're not acting in their capacity as a partner, also excluded.
So basically, payments that resemble wages or are for capital, not direct business profit share, are generally carved out.
That's a good way to put it. Beyond that, QBI does not include items treated as capital gains or losses under any tax provision, so no capital gains. Nor does it include dividends and dividend equivalents, or interest income that isn't properly allocable to a trade or business. Think about interest earned on money just sitting in your business savings account. That's generally investment income, not QBI, unless maybe you're a bank or a lending company where interest is your business. Also excluded, gains or losses from commodities transactions or foreign currency transactions, income, loss, or deductions from notional principal contracts, annuities unless they're received in direct connection with the trade or business. And finally, remember, qualified REIT dividends and qualified PTP income are explicitly not QBI. They are distinct components of your overall QBI deduction, calculated separately with their own 20% rate because they have their own specific rules. Making that distinction is critical for the math.
Don't mix apples and oranges, essentially.
Precisely. And a quick but vital note on things you might see on, say, a Schedule K-1 from a partnership or S-Corp, or Form 1099 PATR from a cooperative. Just because an amount is reported on one of these forms doesn't automatically make a QBI. You or your tax advisor must verify that these items meet the QBI criteria based on their underlying nature and how they're reported on your federal return. For example, for Form 1099 PATR payments from a co-op, they must be related to your trade or business, reported by the cooperative as qualified payments, and crucially, not be from an SSTB unless your income falls below those specific thresholds we discussed earlier. The QBI flowchart, which we'll definitely touch on, is your ultimate guide here for making these calls.
Absolutely. And this brings us to a really common area of confusion and a key planning point for many businesses, especially maybe those just starting out or perhaps experiencing some lean years. How do you handle losses for QBI purposes? Here's the rule. Qualified losses or deductions from a trade or business that are suspended by other provisions of the Internal Revenue Code. For instance, maybe you have limitations under Section 163J for business interest expense, or Section 179 limitations on expensing property, or Section 461(2) for excess business losses, or maybe passive activity loss rules under Section 469, or basis limitations for partners' core shareholders. Any of those suspended losses or deductions are not included in your QBI calculation for the year they are suspended.
Okay, so you don't get the QBI hit in the year the loss happens if it's suspended by another rule.
Exactly. It's a critical timing rule. Instead, these qualified losses and deductions are only taken into account for QBI in the tax year they're actually allowed in computing your overall taxable income. This means loss tracking is absolutely critical for long-term tax planning. When losses get suspended, you have to meticulously determine and track the qualified portion of those losses that will eventually flow into QBI in subsequent years when they finally become deductible. The IRS, thankfully, acknowledges this complexity. They even provide a QBI loss tracking worksheet in the Form 8995A instructions. It's an invaluable tool to help you maintain accuracy over time. And a very important note here, generally, losses and deductions that were incurred prior to 2018, before the QBI deduction even existed, are not considered qualified losses or deductions. They are not included in QBI, even when they are eventually allowed post-2017. So your tracking needs to be quite granular, distinguishing pre- and post-2018 losses.
Wow, okay, so old suspended losses don't count for QBI, only losses from 2018 onwards that were suspended and later allowed.
That's the general rule, yes. The IRS specifies using the first-in, first-out FIFO method for applying these prior year suspended QBI losses when they become allowable. You use up the oldest ones first. If a loss or deduction was only partially suspended in the year it occurred, then only the allowed portion attributable to QBI is considered in that initial year. There's also a specific nuance for SSTB losses. If an SSTB incurred a loss, its qualified status, whether it counts as QBI or not, is determined based on your taxable income in the year the loss occurred, not the year it's eventually allowed. So if your income was within the phase-in range back in that original loss year, the applicable percentage is determined then, and that qualified portion carries forward. It's not redetermined later when the loss is finally allowed, even if your income is different then. Prevents gaming the system based on income fluctuations.
That makes sense. Locks in the character of the loss from the start.
Exactly. And finally, what if you have an overall qualified business net loss for the current year? Maybe one business made money, but another lost more. If your total QBI from all sources is negative, you actually don't get a QBI deduction for the current year, unless you happen to have positive qualified REIT dividends or qualified PTP income to offset part of that business loss. Any overall QBI net loss for the current year will carry forward to the next tax year to reduce QBI in that future year. You'll report this carry forward amount on Part 4, Line 40 of Form 8995A.
It's important to stress, though, that this QBI loss carryforward doesn't affect the deductibility of the loss for purposes of other tax code provisions, like your general net operating loss calculation. It's solely for QBI calculation purposes in future years. This whole section on losses really underscores how crucial good record keeping and understanding these carryforward rules are for long-term tax planning and truly maximizing future deductions.
That's a super important point about loss tracking. It really does sound like a detail that could easily be overlooked, but it's clearly vital for long-term accuracy and making sure you don't miss out on deductions down the road. Now, let's move on to those other two key components of the limitation calculation that we mentioned earlier. W-2 wages and qualified property, which often goes by its acronym UBIA. Precision in understanding and calculating these components is absolutely critical for maximizing your deduction, especially for those in the higher income brackets where these limitations really start to bite.
Absolutely. This is where the rubber meets the road for many higher income businesses.
First, let's look at W-2 wages for limitation purposes. What counts? Generally, it includes the total amounts paid to employees for the performance of services. Plus, it includes elective deferrals they might have made, think contributions to 401k plans, certain deferred compensation, even Roth IRA contributions made through payroll. It's important to remember, though, amounts paid to statutory employees are not considered W-2 wages for this specific calculation, unless that statutory employee box 13 on their Form W-2 is checked. We're really hammering that point home. Now, if you operate more than one trade or business, or you have an aggregation group, the W-2 wages must be carefully allocated among those various activities. They have to be assigned specifically to the trade or business that actually generated that wage expense. Only the W-2 wages properly allocable to generating QBI are includable in this limitation calculation.
So you can't just pool all wages from all businesses if they aren't related to the QBI source.
Correct. It needs to be tied to the income-producing activity. Now, the IRS outlines a few precise methods for actually calculating the W-2 wage amount for this deduction. Your tax software or your accountant will likely handle the specific mechanics, but the key takeaway is that these wages have to be properly allocated to the business activity generating the QBI. It's all about ensuring accuracy. You don't necessarily need to memorize every step of the calculation, but understand the principle. Broadly, these methods involve looking at specific boxes on your employees' forms W-2, like Box 1 wages and Box 5 Medicare wages, and factoring in those elective deferrals accurately. And there are a couple of important compliance caveats. Don't use any W-2 amounts from forms filed more than 60 days after their due date, including extensions. And an amount cannot be treated as W-2 wages for more than one tax year or by more than one taxpayer. That's the non-duplication rule, making sure the deduction isn't improperly inflated by counting the same wages twice.
Okay, so accurate allocation and timing are key for the wage component. What about the property side, the UBIA?
Right, the other side of the limitation coin.
Complementing the W-2 wages, the other key component for the limitation calculation is the UBIA of qualified property. UBIA stands for unadjusted basis, immediately after acquisition. Think of it simply as the original cost of your business property when you first put it into service, before you start taking any depreciation deductions on it. It's the starting basis. So what counts as qualified property? It has to be tangible property, something you can touch, like buildings, machinery, equipment, furniture. That's subject to depreciation under Section 167 of the tax code. And it must be held and used in the production of QBI by your trade or business or your aggregated group, both during the tax year and still held at the close of the tax year. Crucially, its depreciable period hasn't ended before the close of the tax year. This depreciable period, for QBI purposes, ends on the later of two dates, either 10 years after the property was first placed in service by you, or the last day of the last full year in its applicable MAGS-IS recovery period under Section 168C. This 10-year rule is a key longevity requirement. It ensures the property isn't just some fleeting asset bought and sold quickly. It has to have some staying power in the business.
So older assets might fall out of the UBIA calculation even if they're still being used.
Yes.
Exactly. If it's past the later of 10 years or its normal recovery period, its UBIA no longer counts for this limitation, even if it's still on the books and generating income. Now, what about improvements? If you make improvements to property that has already been placed in service, those improvements are treated as separate qualified property. They get their own UBIA, the cost of the improvement, and their own depreciable period tracking starting from when the improvement was placed in service. There are also special rules for property acquired in certain non-taxable transactions, like Section 131, like-kind exchanges, or Section 133, involuntary conversions.
Generally, the UBIA of the replacement property you receive is the same as the UBIA of the property you gave up, with adjustments for any boot, cash, or non-like-kind property received or paid. While the replacement property typically retains the same original placed-in-service date for the carryover basis part, any portion of the replacement property's UBIA that exceeds the relinquished property's UBIA, like if you paid extra cash, is treated as separate, newly placed-in-service property with its own UBIA and start date.
Okay, so basis carries over, but new money creates new UBIA.
Pretty much. Similar rules apply to property received in other non-recognition transactions, like contributing property to a corporation under Section 351. Or to a partnership under Section 721. Generally, the recipient entity retains the transfer's UBIA and placed-in-service date for the carryover basis portion, but any excess UBIA, from boot paid by the entity perhaps, is treated as new property. And here's a really important anti-abuse rule to be aware of. It's designed to prevent manipulation around year-end. Property acquired within 60 days before the end of the tax year, that is then disposed of within 120 days after being acquired, without having been used by the trade or business for at least 45 days before disposal. That property is generally not considered qualified property. The UBIA doesn't count. This clever rule prevents taxpayers from, say, buying a big piece of equipment in late December just to boost their UBIA for the limitation, only to sell it off in January without really using it.
Ah, the old buy and sell trick is blocked. Good to know. Understanding these UBIA nuances is clearly essential for accurately calculating that limitation and maximizing the QBI deduction if you're subject to it. Fascinating how the IRS really tries to anticipate almost every possible scenario to ensure fairness, or at least compliance. Now let's wrap up our discussion of the individual components that make up the overall QBI deduction by talking about that third piece, REIT and PTP income. This is another area that, while maybe simpler in some ways than the core QBI calculation from a business, can still provide significant tax savings, especially for those with investment income from these specific sources.
Right, it's a separate component but adds to the total deduction.
Exactly. Your REIT PTP component is relatively straightforward mathematically. It simply equals 20% of your qualified REIT dividends plus 20% of your qualified PTP income or loss. This includes your share of these items flowing through from other relevant pass-through entities as well. Now, to be considered qualified REIT dividends, the dividends you receive from a real estate investment trust must meet a few criteria. They have to be from a REIT share you held for more than 45 days during a specific period around the ex-dividend date. You can't have an obligation to make related payments to someone else for that dividend, like in certain hedging transactions, and it can't be a capital gain dividend or a qualified dividend that gets preferential rates under Section 1H11. Importantly, qualified REIT dividends also include those received from a regulated investment company, or RICE, like a mutual fund, if the RICE designates them as such. You'll typically find these reported on your Form 1099 DIV, specifically in Box 5, often labeled something like Section 199A dividends.
So look for Box 5 on the 1099 DIV.
That's the key spot. As for qualified PTP income or loss, this includes your share of qualified items of income, gain, deduction, and loss from a publicly traded partnership, but only if that PTP is not treated as a corporation for federal income tax purposes. Most are partnerships, but some are taxed as core. It can also include gain or loss you recognize when you dispose of your PTP interest, but only the portion that's not treated as a capital gain or loss, often related to hot assets like inventory or receivables. However, just like with a regular QBI, it does not include any loss or deduction from the PTP that was disallowed in determining your taxable income for the year due to other limitations, like basis or passive activity rules. Those suspended PTP losses wait until they're allowed. And a quick but important note here, echoing what we discussed for regular QBI from SSTBs, PTP income that's generated by an SSTB activity conducted by the PTP. That income may still be limited to the applicable percentage if your overall taxable income is within the phase-in range, or it could be completely excluded from being qualified PTP income if your taxable income is above that phase-in range. So the SSTB rules can still apply to this REITTP component too, requiring you to remain vigilant even with these types of investment income.
Right, the SSTB tank can follow the income even into the PTP world if your income is high enough. Okay. So now that we've meticulously broken down all the individual pieces, the core QBI, the limitations involving W-2 wages and UBIA, and this separate REITTP component, let's talk about actually putting it all together. This is where Form 8995A truly serves as your step-by-step guide, transforming all those complex rules we've discussed into a concrete number on your tax return. Think of this as your practical item-by-item roadmap to actually completing the form. And the very first strategic thing you really need to do, even before you start filling out Part 1 of Form 8995A, is to figure out which, if any, of the supplemental schedules A, B, C, or D you'll need to complete first. This pre-computation check is vital for an accurate and efficient process. Prevents you from doing unnecessary work or missing a required step.
Okay, so figure out the schedules first. What triggers each one?
Good question. You might need Schedule A, Form 8995A, if your trade or business is an SSTB and your taxable income falls within that tricky phase-in range we discussed earlier. Remember, for 2024, that's taxable income more than $191,950, but not more than $241,950 for most filers, or more than $383,900, but not more than $483,900 if you're married filing jointly. If your income is below those lower thresholds, you generally be using the simpler Form 8995 anyway, which avoids this complexity. You'll need Schedule B, Form 8995A, if you're choosing to aggregate multiple trades or businesses into a single one for the calculation purposes. As we discussed, that can be a genuinely powerful tax-saving strategy to help overcome the W-2 UBIA limitations. You report the details of the aggregation on Schedule B. Then there's Schedule C, Form 8995A. This schedule is necessary if any of your individual trades, businesses, or aggregated groups have a qualified business loss for the current year, or if you have a qualified business net loss carry forward from prior years that you need to apply this year.
This is where the loss netting happens, offsetting your current year QBI losses against QBI gains from other businesses, and also where you meticulously track any remaining loss to carry forward to future years. This schedule works hand in hand with that QBI loss tracking worksheet we mentioned earlier. Keeping detailed records there will make completing Schedule C much smoother and ensure you capture all eligible future deductions from those losses. Finally, Schedule D, Form 8995-A, is specifically for patrons of agricultural or horticultural cooperatives if you're claiming a QBI deduction related to your business dealings with such a cooperative.
Got it. A for SSTB phase-in, B for aggregation, C for losses, D for co-ops.
You got it. Once you've figured out which schedules apply to you and completed them, you'll need to calculate another crucial figure that influences many of the form's parts: your taxable income before the QBI deduction. For most folks filing Form 1040, 1040-SR, or 1040-NR, this is simply line 11 adjusted gross income minus line 12 standard or itemized deductions of your Form 1040. This taxable income figure is absolutely fundamental. It dictates whether you're using Form 8995A at all based on those thresholds, and then if you are, it determines many of the limitations and phase-in calculations throughout the form. Getting this number right is really the foundation for your entire deduction calculation.
Right. Getting those initial figures, the schedules needed, the taxable income correct really sets the stage for the rest of the form. Let's briefly go through the main parts of Form 8995A itself, just understanding what each section helps you achieve in terms of calculating that final deduction. Part I is pretty straightforward. It's all about your trade, business, and aggregation information. This is where you'll provide the basic identifying details for each qualified business or aggregation group you have. If you've aggregated businesses on Schedule B, you'll simply enter the aggregation group name you chose, like Aggregation 1, and check the box indicating it's an aggregation. For individual businesses not aggregated, you'll enter the business name and its employer identification number, EIN, or your social security number, SSN, if it's a sole prop without an EIN. It's essentially just setting the stage, listing out each income stream you'll be analyzing.
Laying out the players, so to speak.
Exactly. Moving on, Part 2 is where you determine your adjusted QBI. This is really the engine room of the form. This is where you calculate the adjusted QBI for each individual business or aggregation group, factoring in those W-2 wages and UBIA limitations we delved into earlier, but only if your income is high enough to trigger them. This is where the potential deduction amount for each business truly takes shape, after applying any necessary limits. It's important to note there's a little instruction there. If the QBI for a specific trade or business is 0 or less, then the corresponding W-2 wages and UBIA of qualified property for that specific business must also be treated as 0 for the calculation. They don't count towards the limitation if there's no positive QBI from that source for that year.
Right, no wages or assets without income to support them in that context.
Correct. Part 3 is specifically for the phased-in reduction. You'll only complete this part if your taxable income falls smack dab within that tricky phase-in range we keep mentioning, meaning it's more than $191,950, but not more than $241,950 for most, or more than $383,900, but not more than $483,900 for married filing jointly. And your calculated QBI component, after the W-2 UBI limit started phasing in, is actually less than the overall limit based just on 20% of your taxable income. If you're outside that specific income range, either below the lower threshold or above the upper phase-in limit, you skip this section entirely. This part is solely about precisely calculating that gradual reduction if you're in that middle income tier where the rules partially apply.
It's a very targeted section for that specific income bracket.
Exactly. And finally, part 4 is where you determine your QBI deduction. This is the grand finale. Here, you'll bring together your final calculated QBI component from part 2 or 3, potentially reduced by losses from Schedule C, with your REITTP component, which is simply 20% of that income. Then you'll apply that crucial overall limitation. The lesser of the combined QBI and REITTP amounts, or 20% of your taxable income adjusted for net capital gains. This section ties all the prior calculations together, QBI, losses, limitations, REITTP, to arrive at your final powerful QBI deduction number that goes onto your Form 1040. And remember, if your net amount here results in an overall QBI loss after combining everything, that loss will be carried forward to the next year, line 40. But this carry forward doesn't affect the deductibility of that loss for any other tax code provisions this year. Part 4 truly brings everything together into your final deduction figure, directly reducing your taxable income.
That's a great overview of the form's flow. And to really tie all these pieces together and empower you, the listener, with a clear decision-making framework as you look at your own income streams. I really can't stress enough the value of the QBI flowchart. It's Figure 1 and Figure 2, and the official IRS instructions for Form 89995A. Think of it as the ultimate guide for determining if any specific item of income, gain, deduction, or loss is actually includable in QBI. It provides a clear, step-by-step logic that walks you through the critical decision-making process.
Like a troubleshooter's guide for QBI eligibility.
Exactly. Let me just quickly walk you through some of the key decision points from that chart, just so you can internalize the logic and apply it to your own situation. First, you always ask, is the item effectively connected with the conduct of a trade or business within the United States? If the answer is no, stop right there. It's not QBI. Second, is the item from a qualified trade or business? This covers your general business income and deductions, but also includes things like the deductible part of SE tax, SE health insurance premiums, and retirement plan contributions related to that business. Third, if it's coming from a pass-through entity like a K-1, did you determine it to be ordinary business income, not something capital or personal in nature? Fourth, is the item actually included in figuring your taxable income this year? This is crucial because remember, if losses or deductions are suspended by other tax rules, like basis, at-risk, passive loss, or excess business loss rules, they are not QBI until the year they are actually allowed in computing taxable income.
The timing question again.
Always important. Fifth, is the item treated as a capital gain or loss, or perhaps a dividend or dividend equivalent? If yes, generally not QBI. Sixth, is the item interest income other than interest income that's properly allocable to a trade or business? For example, interest from just parking working capital in a savings account. Usually passive, usually not QBI. Seventh, is the item an annuity other than one received in direct connection with the trade or business? Probably not QBI. Eighth, is the item from a commodities transaction, foreign currency gain loss, or a notional principal contract? Generally excluded. Ninth, is the item qualified PTP income or loss? If yes, remember it's not QBI itself, but it goes into that separate REITTP component calculation. 10th, is the item W-2 wage income, unless statutory employee box 13 is checked? Usually no. 11th, is the item reasonable compensation from S Corp, a guaranteed payment from a partnership, or a payment for services performed other than in a partner capacity? If yes to any of these, it's generally not QBI. And finally, the big one that really guides strategic decisions, especially for service providers. Is the item related to an SSTB? If the answer is yes, the flowchart then sends you down a path that depends entirely on your taxable income level for the year. Is your taxable income at or below the initial threshold, $191,950 or $383,900? If so, great news, it is treated as QBI. Is your taxable income above that threshold but still within the phase-in range? Then is partially includable as QBI, and the chart directs you to Schedule A to calculate that specific applicable percentage. Or is your taxable income above the phase-in range entirely? In that case, unfortunately, income from that SSTB is completely excluded from QBI. This flowchart truly is the definitive guide. It helps you walk through the logic for each specific income or loss item, making sure you correctly identify and leverage every possible tax-saving opportunity related to QBI.
That flowchart really does sound like it simplifies what could otherwise be an incredibly overwhelming process, gives you a clear, actionable path for each piece of income. And just as we wrap up this deep dive, it's probably important to briefly touch on how the QBI deduction interacts or coordinates with other critical tax provisions because, nothing in tax law really operates in a vacuum. Understanding these interactions helps ensure your overall tax strategy is sound.
Good point.
Yeah.
How does it play with things like NOLs or AMT?
Right. For instance, when you're calculating a net operating loss, an NOL, under Section 172, your QBI deduction is generally figured without taking the NOL itself into account. What this means practically is the QBI deduction cannot, by itself, create or increase an NOL carryback or carry forward. However, an excess business loss under Section 461, which is treated as part of an NOL carryforward, is considered for QBI purposes, but only in the subsequent tax year when that excess business loss is finally allowed as a deduction. When determining your alternative minimum taxable income, or AMTI, you start with your regular taxable income calculated before applying the QBI deduction. The QBI deduction then reduces your AMTI in the same way and by the same amount as it reduces your regular taxable income, so it helps with AMT too.
That's good news for AMT payers. What about self-employment tax? Does it reduce that?
That's an important distinction. No, it doesn't. Your net earnings from self-employment, which are the basis for your self-employment tax, Social Security and Medicare, are not reduced by the QBI deduction. So while this deduction powerfully lowers your income tax liability, it doesn't lower your SE taxes. That's calculated before the QBI deduction comes into play. Similarly, your net investment income is not reduced by the QBI deduction when you're computing the net investment income tax, NIIT, that extra 3.8% tax on certain investment income for higher earners. And finally, just a quick note for those operating businesses in U.S. territories. For QBI purposes, the definition of the United States includes Puerto Rico. This means if you have taxable income from sources within Puerto Rico that are subject to U.S. tax, that income can qualify for the QBI deduction. Plus, W-2 wages for the limitation calculation include wages paid for services performed in Puerto Rico. All of these coordination rules help ensure consistent application across the various parts of the tax code, allowing for more holistic tax planning. So what does this all mean, after all this detail? It means taking the time to truly understand these rules, particularly those laid out in the, let's be honest, very detailed instructions for Form 8995A. It can literally put more money back in your pocket. The QBI deduction is a significant tangible opportunity for business owners and self-employed individuals to reduce their taxable income and, by extension, their overall tax liability. It's complex, yes, we won't deny that, but it's entirely navigable, especially with tools like the flowchart and careful reading, and with the right approach, it can be incredibly rewarding.
I absolutely agree. And if we connect this to the bigger picture, it really highlights that tax preparation isn't just about, compliance and filling out forms correctly. It's really about strategic financial management and, frankly, empowerment. Understanding these forms, these nuances, and especially those critical income thresholds, the SSTB definitions, the limitations, it equips you to make informed decisions that directly impact your bottom line. It's about proactive engagement with your financial situation rather than just reacting at tax time. And this raises an important question. How many other deductions or tax-saving strategies might you be eligible for that you aren't aware of, simply because you haven't taken the time to do a deep dive into the instructions or ask the right questions?
That's a perfect thought to leave everyone with. Consider this. The IRS provides these detailed instructions, these forms, these flowcharts, not just for compliance, but effectively as a roadmap to legal tax optimization. They're telling you the rules of the game. So how might consistently applying this deep dive approach, really digging into the details, to your personal and business finances transform your financial future beyond just getting a bigger refund on this year's tax return? It's a journey worth taking, we think.
Yeah.
One that leads not just to potential tax savings, but maybe more importantly, to genuine financial clarity and control. Until next time, keep digging, keep learning, and keep thriving.